Welcome to episode 2 of Bishop Cross Border Investment Services podcast. I'm Lee Scully. I'm an associate investment advisor. This is Stephen Bishop, investment advisor. In this episode, we're going to discuss the concept of active investing and being tactical versus the more traditional method of buy and hold investing. So maybe I'll start off just by articulating how the industry and how the world and the markets have evolved over the last several decades. It's been an environment where things seem to go up and up all the time, especially in the last 2 decades. That seems to be something that might change in the future going forward. The next 20 years might look quite different. And if that's the case, the buy and hold strategy might be quite problematic for people that follow that philosophy, whereas a tactical selective strategy where you're moving in and out and you're paying a lot more attention to what you own, when you own it, why you own it, that's the strategy that will serve you in an environment where things are a lot more chaotic than they've usually been, and we've got much less visibility than we've ever had in terms of what to expect in the future. So what thoughts do you have on buy and hold investing versus active tactical investing?
Well, my first thought would be it depends. It depends on where we are in the cycle. And because let's just say if we had just experienced a 50% drawdown in the markets, which we haven't had since 2008, 2007 to 2009. If we were at that part of the cycle, you probably could close your eyes and buy just about anything and hold it.
That's been a winning strategy.
Well, but that's not where we are. We're at the latter stages of the cycle. And a lot of people have done well if they had things back into 2009. So, you're talking, 17 years, let's say. Mm-hmm. But things just don't go up forever. But when you go 17 years without a material correction, people forget that. Mm. If you've been around like me, going back to 86, let's say, and experiencing my first market crash in 1987, and then
the flash crash,
and then market went down 20% in a day. Mm. So could you imagine that if that happened today? If the market went down 20% in one day, what would people do? They wouldn't know what to do.
People in the 60-40 buy and hold model would get hit pretty hard.
It would be disastrous. Well, it would be disastrous for anybody.
Yes.
So since we haven't had any material market event in 17 years, a person should be aware that this can happen, and it can happen anytime. And if you want to get into some of the guru stuff, like the Warren Buffetts of the world, who says if a person can't tolerate seeing their stocks down 80% at any given time, they shouldn't buy stocks.
That's right.
Okay. And that's something that most people today don't think about, because they just bought and things go up, and half the time people don't even know what they own. So if you were at the end of a bear market or at the bottom of a cycle where things had gone down this 50% and it's starting to correct upward, and it doesn't go straight back up, it takes a long time, but you could probably buy just about anything that of value and hold it, and it would work out for a while.
Right.
But then you get into periods in the cycle like we're in, and it's probably not going to work. And so when you talk about tactical or active management, those types of strategies are more suitable for environments like we're in today, where the investments are more based on looking for things that are cheap in an expensive market,
Right.
and having specific, entry points and specific exit points, and taking profits when you have them, because in an environment like this, you could buy something today and it could go up, and then it could go down, and then it could go up, and then it could go down. And 10 years later, you're probably back to where you started. Mm-hmm. And we've had periods of that in the past as well. So being more active or more tactical in this environment is probably more conducive for people that want to own stocks, and with the objective to make some higher returns and something guaranteed, but not get profits and then watch them disappear. If you get a profit, you take a profit. So the environment today is one where you can listen to any on the news. The markets are the most expensive they've ever been in recorded history, and so on. And
That's right.
And all the gurus like the Warren Buffetts are sitting on huge piles of cash uninvested because they can't find anything worth buying, and so on. So an environment like this, a tactical approach to investing in stocks is probably the best approach versus the old traditional, buy and hold. Because at some point we're going to have something happen.
It always does.
It always does. And if you're passive means you don't pay attention to it.
That's right.
And if you're going to own exposure to risk assets, stocks, you need to pay attention to them. And if you're not going to pay attention to them, well, maybe you shouldn't own them.
That's right. I think that speaks to the complacency that investors have now, because it's been 17 plus years of things going up all the time, and people have become quite unfamiliar with the dreaded S word, right? Selling. People don't really sell anything anymore.
They haven't had to.
Exactly. So, and people too, having had the last 17 years of more upside than downside, have become accustomed to expecting more upside than downside on everything, and everyone's asking, how much can I make? A lot of the time, the question you want to be asking is, how much could I lose?
Yes. It's always, sometimes the best investments are the ones that go down the least.
Right.
And so if a person's dealing with money that's necessary, like retirement money. So you're not working anymore. You're not 30. You're not at that phase in your life. You're not 30 and saving. And you've got another 30 years left before you're going to use that money. Well, that's one scenario. But when you're 60 or thereabouts, or 70 or 55, whatever number you want to, and retired, and if that's all the money you've got, and you're not working anymore, so you've got no way to replenish what you lose, a person wants to look at it quite differently, because then it's not about how much you can make. It's about how much you can keep.
Exactly.
And what you can get for a return on a somewhat lower risk profile. And that's really, I think that is something that people need to revisit, because people have forgotten that things go down. And we're in an environment now where there's a lot of risk. I don't know when it's going to go down. Or when things will happen, but it will. And if a person's retired and that's all the money they have, and if they've got no way to get it back, and they need to live off of that money, they need to revisit this. And And so whether it's tactical investing by using bonds or stocks or just the tactical allocation of where the money's placed and those types of things, that word tactical is something that in today's world people need to understand and discuss with their advisors and invest their money accordingly.
It's a great point, especially to think about where you are in life, because had you invested $1 at the height of the dot-com bubble in 2000, you probably didn't recover that dollar until 13, 14 years later. It was
13 years.
2013. So if you're 65 or 70 and you have stocks, do you have 13 years to recover that value if it drops? In most cases, no, because you need the income from your...
I don't know anybody.
So you can't...
I don't know anybody.
So you don't want to put yourself in that situation, right, where you're exposing yourself to that downside and no one knows when or if it's going to come back. So things to think about, and you want to avoid being complacent, especially when you're at that stage.
Yep. Yeah, we can revisit this on another cast as well.
Of course.
But it's something people really need to be aware of today in this environment.
Agreed. Yeah, things are quite chaotic in the world and in markets these days. So I think that's a pretty good quick summary of the pros and cons of buy and hold, sell, be tactical.
There's a time for buy and hold.
There is.
It's not today.
Not today. Agreed.
It's not today.
So that's a good quick run through of that concept. I'm sure we'll talk about that more in future episodes, but for the listeners, I think that's a good quick topic.
Right on.
All right. Thanks, Stephen.
You're welcome. Thank you.